Negative leverage. What is it? Is it good? Is it bad? Is it common or is it uncommon? How does it affect a transaction? Well, we're going to answer those questions quickly here in the next couple of minutes because the fact of the matter is negative leverage is occurring all over the US today. Negative leverage occurs when cap rates are lower than your cost of capital. So the return on your asset is less than the interest that you pay on your mortgage. It crushes transactions, and it is one of the reasons why we have seen so few deals trade over the course of the last 12 months. A friend of mine runs one of the nation's largest multifamily investment platforms, and their version of pencils down is 10 deals closed thus far this year. The way they got those deals to close is unique financing, not using traditional means. And I won't go into it because it's closely held secret. But the reality is deals are occurring, but it's because there's a creative financial structure associated with it. Again, let's just talk about it real quickly. Negative leverage hasn't occurred here in the US since the mid 1970s. So it is a very, very rare event. It makes most transactions using market cap rates and market interest rates unfeasible. So let's use multifamily as an example. Today, Freddie, Fannie, adjustable rate mortgages are somewhere in the low to mid 7% range. Cap rates haven't moved much over the course of the last 12 months. Average cap rates are somewhere between 5 and 6%. So you've got a 5% cap rate, just as an example, and a 7.5% cost of capital or your interest rate. You have negative leverage. You have negative cash flow, assuming that you could finance 100% of the acquisition, which of course doesn't work, but just hypothetically, you will lose money on a daily, weekly, monthly, and annual basis. It doesn't work. It's not sustainable. That's the other thing. Negative leverage is not sustainable and will resolve itself. And there's really two ways that negative leverage gets resolved. One, cap rates float above cost of capital, adjustable rate mortgages, generally speaking, but you can also use fixed rate as sort of your proxy. So cap rates will come up, or cost of capital, your interest rates will go down. What's the probability of either of those occurring? I think very, very strong. Let's start with interest rates. The Federal Reserve have implied that in their infinite wisdom, they need to elevate and hold interest rates at relatively high numbers for an extended period of time. They were very hawkish in their last meeting. I have a whole lot to say about the Federal Reserve, and none of it is good, quite frankly. They have certainly put us in the situation that we're in, starting with a massive injection of liquidity back in 2020, but that's neither here nor there. The reality is we should not expect interest rates to decline in the near term significantly. That means that cap rates will have to go up. What's going to force cap rates up? Transactions. And if you follow me, you know that we're seeing a huge wave of distressed debt, I should say, coming our way over the next 12, 18 months. A lot of it is maturities. We've got more than $1.5 trillion in maturing commercial real estate debt over the next 18 months. And the problem is we're in the middle of a credit crunch. Regional banks, who are a heavy player in this game, are essentially out of the market. They're deeply concerned about deposit flight and credit quality in their portfolio. And they should be. There are several hundred regional banks that are on the watch list of the Federal Reserve and OCC and FDIC, and rightly so. The three banks, let's just focus on three, First Republic, Silicon Valley, and Signature Bank, were three of the top four largest bank failures here in U.S. history. So, yeah, that's just the tip of the iceberg. Anyways, getting back to the issue of negative leverage, cap rates will go up because distress in the marketplace is increasing, and it's increasing dramatically. I am the chief restructure officer at Performance Advisory Group, so I literally work out commercial real estate loans on behalf of my clients, big and small. Whether you're a publicly traded or a one-off owner, you've likely either heard of us or worked with us in restructuring your debt. We create Solutions around defaults or probable defaults. So if it's a loan maturity, we'll seek an extension. If it's a cash flow issue, we'll look at adjusting either amortization or cost of capital interest rates, or both. We do full-blown restructures. We do discounted payoffs. So look, we're on the front line. We're seeing on a daily basis exactly what's happening here, and the distress is going to be significant. So two things you could do. You can either retreat from the distress or you can attack it. We suggest attacking it. There's going to be generational opportunities to acquire brilliant pieces of commercial real estate at deep, deep discounts. And it's already happening, obviously, in the office space. I mean, office potentially is down 40 to 70% from pre-COVID, pre-pandemic pricing levels. We're seeing 75% discounts for Class A office in downtown San Francisco. We're seeing similar discounts for regional shopping centers and hospitalities, also in San Francisco. Now, that's a combination of post-COVID drama as well as poor regulatory policy and policing on the streets of San Francisco. Either way, guys, the reality is this: distress is hitting the marketplace. We're seeing it firsthand, and I'm sharing with you. It's going to be significant. I've been in the business for more than 32 years, starting as a young vice president with a national bank in the early 90s. This is as bad as it was back then. And by the way, back then, early 90s was far worse than the great financial crisis. So prepare in a variety of ways. If you own commercial real estate and you are facing a potential default, reach out to me. I'll send you my book. It's a bestseller on how to restructure and modify commercial real estate debt. So I give you all the insight that you need to know, and it's free. If you have challenges and would like some assistance, that's what we're here for. That's one of the things we do. And I would dare say that we do it as well or better than virtually anybody else out there. I know, kind of cocky, but I've been in the space a very, very long time. Most people at my vintage essentially stepped out of the business, but I'm still going because I love it. But the other thing is, if you're looking at investing, there's going to be, again, extraordinary opportunities over the course of the next 4 to 6 years. And I say 4 to 6 years because that's generally how long it takes to go from top of cycle to bottom of cycle based on historical trends. And by the way, this issue of maturing debt of 1.5 trillion in commercial real estate, that same number is matched by corporate securities. And guys, we're going to see huge defaults also in publicly traded equities. So something to look out for. Thank you for sticking around. Thanks for watching. Again, if we could be assistance, reach out to me directly. If you're watching this on YouTube, please like or dislike and subscribe. If you would be so kind, that would be very helpful. And also leave a comment. Tell me what would you like me to cover next, or what you did and did not like about this presentation. In any event, again, have a great day. Thank you again for being here. Blessings to you and all that you do.